Summary of The Simple Path to Wealth by J.L. Collins, your roadmap to financial independence and a rich, free life, written and narrated by JANKY Mind. Introduction. The world of personal finance can often feel overwhelming. Everywhere you turn, there's a new strategy to consider, a hot stock to watch, or a financial guru claiming to have the secret to unparalleled wealth. But what if the real secret to growing your wealth isn't found in the latest trends or complex algorithms, but in timeless, straightforward principles? What if instead of chasing the next big thing, the true path to financial success involves understanding the basics and having the discipline to stick with them? Amidst the noise of financial advice, there lies a simpler and more intuitive strategy. One that doesn't involve jumping from one investment to the next or trying to time the market perfectly. A strategy where simplicity isn't just a preference, but the very foundation of financial growth. In this audiobook, you'll learn the virtues of straightforward investing, the pitfalls of trying to outsmart the market, and the importance of a stoic approach to market volatility. You'll uncover the magic of index funds, grasp the concept of rebalancing, and appreciate the importance of a long-term vision. As you delve deeper, insights into preparing for retirement and the joy of philanthropic giving will come into focus. Equip yourself with these principles, and you're well on your way to navigating the financial landscape with clarity and confidence. Chapter 1. The Blueprint to Financial Independence. Envision yourself unshackled from the burdensome chains of debt, holding the key to your life's steering wheel. That key, it's called FU money. Imagine having that liberating nest egg, granting you the autonomy to walk away from unsatisfactory work conditions or any unfulfilling situation, placing the power of choice firmly in your grip. But to grasp this power, you first need to undergo a paradigm shift in your relationship with money. Instead of being tantalized by the immediate pleasures money can procure, consider taking a more profound, future-oriented perspective. Think of your dollars as diligent workers, laboring tirelessly in the world of investments, multiplying and increasing their ranks over time. This continuous, compounded growth paints the picture of potential wealth accumulation in vivid colors. Remember, every choice has its cost. In this case, we have the opportunity cost. When you spend, you're not merely parting with your money, you're losing its future potential. Take splurging on a luxury car, for example. That $40,000 might give you an instant thrill, but it's simultaneously robbing you of the manifold returns it could have fetched had it been wisely invested. Now, when dipping your toes into the vast ocean of investments, it's crucial to think of it as more than just a numbers game. You're essentially buying seats at the table of successful companies, becoming a partner in their journeys. The numbers on the stock ticker might ebb and flow, but sturdy companies fortify their value foundation over time. As with any journey, there will be storms. The stock market isn't a calm sea, but a turbulent force, where periods of rising and falling stock prices are simply a natural occurrence. Trying to perfectly time these market swings is a wild goose chase, one that even market gurus falter at. Market tumults, from crashes to mere corrections, are but natural rhythms in the life song of the market. Historical patterns show that the market has the tendency to bounce back even from the deepest plunges. The compass to navigate these stormy waters: steadfast resilience. Staying invested, even when the horizon looks bleak, is pivotal. Emotions, especially fear, are treacherous captains that lead ships astray. Decades of compounded growth await those who maintain their course with unwavering resolve, free from the snares of panic and impulsive decisions. In this realm, patience isn't just a virtue, it's the very beacon guiding one towards the shores of financial liberation. Chapter 2. Cracking the Code of the Stock Market. Imagine standing on a beach, watching waves rhythmically crash against the shore. Sometimes, they come in soft, gentle strokes, and at other times, with a fierce, crashing force. Much like these ocean waves, market crashes and corrections are the natural ebb and flow of the stock market. They are expected, consistent, and integral to its nature. The stock market's history is speckled with events of meltdowns. The tremors of the 1970s recession, the thunderous downfall on Black Monday in 1987, and more recent trembles such as the dot-com debacle and the ominous 2008 financial crisis. These events might seem daunting, painting a picture of volatility. Yet, when you zoom out and view the larger portrait, spanning over a century, there emerges a tale of resilience. The market doesn't just recover, it soars higher, charting its unwavering upward trajectory. A lesson from the turbulent 1987 crash highlights the dangers of emotional responses, selling in a moment of panic, only to repurchase at a higher price during the recovery, serves as a warning against reactive decisions, reinforcing the timeless investment wisdom about the unpredictability of predicting market downturns or their subsequent recoveries. And while the allure of hand-picking winning stocks might be tempting, this siren call often leads to shipwreck. Even seasoned investors confess to their sporadic indulgences in stock picking, despite knowing the slim chances of consistently outsmarting the market. To further this, research continuously echoes the same sentiment. A minuscule fraction of expert money managers truly trump broad market indices over extended durations. But here's a refreshing perspective. Think of market volatility as the foam on your favorite pint of beer. It's frothy, unpredictable, and distracts from the actual brew underneath. This brew, the real essence, is the inherent value of businesses, while the transient foam represents the fluctuating prices. Of course, the stock market's annals hold tales of deep dives, like the Great Depression that plummeted values by almost 90%. Yet with factors like dollar deflation cushioning such blows, these catastrophic events remain anomalies in a history marked more by recoveries than recessions. Yet another specter lurks around wealth: inflation. A silent eroder, inflation gnaws away at purchasing power, with extreme forms like hyperinflation causing havoc. While stocks can be a shield against inflationary bites, understanding one's risk appetite is crucial. The stock market's dance is one of rhythm and resilience. Time spent invested in this dance is infinitely more rewarding than futile attempts to choreograph its every move. While grasping the market's intricate dance is enlightening, leveraging this understanding into a concrete investment strategy is the next paramount step in one's financial voyage. Let's look at that now. Chapter 3: Tactics for Resilient Wealth Growth. The tempestuous seas of the investment world are marked by inevitable tides known as market crashes and corrections. These events are natural rhythms, not aberrations. Encountering them requires resilience, not panic. Tempting as it might be to predict or time these market oscillations, such attempts often result in missteps. Many ambitious investors embark on risky voyages, attempting to single out winning stocks or unearthing the elusive market-beating mutual funds. But, as history shows, these endeavors can lead to pitfalls. Enter the index funds, like VTSAX, Vanguard's Total Stock Market Index Fund, which captures a broad slice of the U.S. market by encompassing around 3,700 public companies. It acts as a safeguard, preventing one from the dangers of impulsive decisions and the allure of past performances. Time's tapestry reveals a consistent narrative. Stocks are the titans of asset growth, overshadowing contenders like bonds, gold, and real estate. Though they face occasional storms, stocks rise, resiliently soaring upward over the long term. When it comes to investments, complexity may seduce with its promise, but often extracts a heavy price in higher fees and subpar performance. The antidote: a simplified two-fund portfolio. VTSAX, as recommended, forms the cornerstone for aggressive wealth accumulation. And as one transitions to a preservation mindset, VBTLX, Vanguard's Total Bond Market Index Fund, can be introduced, constituting 20 to 25% of the portfolio, to temper the inherent stock market volatility. Rebalancing, a periodic recalibration, ensures your investment journey remains on course, curbing the whims of emotions and aligning with overarching goals. Every investor, while charting their course, must balance their risk appetite with life's financial blueprints. This balance ensures that when market storms rage, a well-set anchor prevents hasty decisions. The expansive reach of VTSAX, housing mammoth multinational corporations, offers investors a global footprint, reducing the urge to diversify into other foreign-centric funds. But of all strategies, one principle stands tall: discipline. The constant hum of market news can be a distracting siren song. Rather than heeding its call, focus on amplifying savings and let the potent alchemy of compounding sculpt wealth. At the end of the day, in the vast ocean of investments, the twin virtues of simplicity and perseverance serve as guiding stars. Embrace the robust offerings of funds like VTSAX, steer clear of the lure of market timing, and let the passage of time, with compounded growth, navigate you to prosperity. Chapter 4. Steering clear of investment pitfalls. In the grand theater of investments, some actors promise center stage performances, captivating audiences with bold market predictions. However, consistently foretelling market swings remains an elusive art. While some fortune tellers might momentarily bask in the limelight when their predictions come true, more often than not, it's about chance rather than skill. Yet, in the midst of this clamor, a quiet champion emerges: simplicity. The investment world is brimming with detailed narratives and intricate structures. However, these complex strategies often disappoint, burdened by their own intricacy and the high fees they carry. Funds that mirror the overall performance of the market, known as index funds, shine due to their straightforward nature. They invest in a wide range of stocks representing the entire market, bypassing the risky endeavor of trying to single out specific winning stocks. Diving deeper, individual stock picking emerges as an endlessly challenging task. Even the sharpest minds, with an arsenal of resources, find problems. Rebalancing, however, provides an anchor in these tumultuous waters. By compelling investors to realign, it encapsulates the wisdom of buying low and selling high, safeguarding one from the sway of emotions. Now, consider the allure of dollar-cost averaging, a strategy that seems imbued with logic, yet when held against the backdrop of time, it often falls short in comparison to lump sum investing. This underperformance stems from a simple truth: markets, by nature, have an inclination to go up more than they go down. A word of caution: intelligence is no armor against scams. Often, the keenest minds fall for the traps. Deceptive allure isn't worn by shady figures in dim corners, but paraded by charismatic personalities under bright lights. Beneath these veneers lie layers of deceit, each deeper than the last. If a proposition gleams too brightly, it's likely fool's gold. The debate on international funds offers another nuance. While they paint a picture of diversification, their tangible benefits blur when weighed against added costs and the unpredictability of currency shifts. Every investor must sculpt their portfolio, balancing their risk appetite with life's necessities. While volatile assets encourage growth, their conservative counterparts ensure stability. Moreover, simplicity in investments transcends mere financial benefits. It weaves a safety net for loved ones, ensuring continuity in financial stewardship, even in one's absence. Here's some timeless wisdom. In the investment realm, where myths abound and voices clash, humility, skepticism, and simplicity are trusted guides. Embrace them, for, as the wise say, humility safeguards both reputation and riches. Chapter 5. Social Security and Philanthropy. As the curtain begins to draw on one's working life in the United States, the spotlight shifts to retirement, illuminating two poignant questions: how to best harness the benefits of Social Security and the art of meaningful giving. First, let's unravel the Social Security conundrum. This system pledges a steady flow of income as you sail into the golden years of retirement. However, the waters get choppy when determining the perfect moment to hoist the sail and claim these benefits. Setting sail early at 62 might seem enticing, as it promises a longer voyage with consistent, albeit smaller, treasures. Conversely, delaying this journey until after the full retirement age offers a more bountiful monthly treasure, but compresses the journey's duration. Here, the winds of expected lifespan and the legacy for one spouse play pivotal roles in charting the course. While concerns arise about the future of Social Security due to its financial challenges and the growing number of retiring baby boomers, it's unlikely to disappear entirely because of the strong voting influence of senior citizens. However, for those under 55, changes may be on the horizon. It's wise to plan as if Social Security might not be there in the future, and if it remains, consider it a bonus. For many, relying on Social Security often provides better returns than depending solely on personal investments. Shifting the focus to philanthropy, giving not only brings joy but can also offer valuable tax benefits. Donor-advised funds present an opportunity to manage your personal foundation, ensuring your donations are made with precision and tax efficiency. However, instead of spreading your generosity thinly, focus it, ensuring your contributions have a meaningful impact. It's important to be discerning, making sure your gifts are used effectively and reach the right people. Sometimes, the most impactful gestures are those without public recognition. Direct giving, even without tax deductions, can have an immediate positive impact in local communities. Embrace the freedom to choose your philanthropic path, as individual choices can greatly enrich the world through acts of generosity. In the journey of retirement, discernment and preparation are paramount. Plan with an understanding of Social Security's trade-offs and prepare for all eventualities. Root your decisions in well-researched charitable causes and give with passion. Fortify your finances with personal savings, and if Social Security benefits come your way, embrace them with gratitude. With this simple foundation, offer your support generously, leaving a lasting impact on the world. Final summary. Simplicity is the key to wealth building. Embrace a long-term vision, allowing compound returns to work wonders over time. Understand that market corrections are inevitable, but resist the urge to sell during downturns or attempt to time the market. Instead, trust in broad index funds like VTSAX for consistent growth, while periodically rebalancing to maintain your desired asset allocation. As you approach retirement, make informed choices about Social Security, factoring in longevity and potential benefits. Finally, when you're ready to give back, do so with intentionality, whether to charities or directly to individuals. With the right approach, you can navigate your financial journey with confidence and simplicity, ensuring a secure future and leaving a lasting impact. This audiobook summary was brought to you by JANKY Mind. We hope you enjoyed it.